ECB President JeanClaude Trichet made a surprise announcement yesterday that an April rate increase is possible. With his thoughts, on the timing and what's to follow, we bring in a member of the ECB's Shadow Council and Chief European Economist at Barclays Capital. Julian Callow is with us now. He is also part of a panel of economists convened by Handelsblatt that meets monthly to discuss ECB policy. Julian, thanks for joining us this morning from Barclays in London. Glad to have you with us. Do you think that JeanClaude Trichet thinks the Eurozone is ready for a rate increase, or is he just sick of the situation with the more marginal members of the EU? I mean, is he running out of patience politically?
No, I think he is actually very focused on what we have been seeing with commodity prices and price pressures starting and threatening to feed through down the producer price chain, and we're seeing a lot of rise in some measures of inflation expectations, particularly among households in response to the higher oil and food prices here. We're seeing businesses having very high price expectations, and ECB is all about keeping inflation expectations well under control. Well anchored is their favorite expression there. So when you look at that and you look at the level of interest rates down at only 1% in nominal terms and minus 1% in real terms, for the ECB, it thinks to itself, well, we have to actually start moving here to get a more normal monetary policy. We feel very uncomfortable with this current monetary stance when we are seeing these inflation expectations building up, when we are getting much more concerned that all the commodity price pressure threatens to spill over with second-round effects into core inflation. Yeah.
All that being said, I know that you're personally concerned that an April move higher by 25 basis points is too soon. Why is that?
Well, for me, I'd rather let a more sustainable evidence build up of recovery in the labour market in the euro area. The unemployment rate is currently 9.9%. It has fallen by a tenth. It was stuck at 10% for many months. So it's starting to come down. We're starting to see the labour market work. But for me, there have been a lot of setbacks, a lot of uncertainties since the financial crisis began. And I really feel that central banks have to be particularly sensitive and accommodative in that respect, particularly as we're now dealing with an extraordinary amount of fiscal consolidation going on in Europe as well. So for me, I would rather get a bit more momentum building up in the economy.
Julian, then do you think that's why, perhaps in somewhat of an odd move, that the ECB is talking about raising rates but not talking about doing anything with any additional liquidity measures? In other words, their QE program is still, we're hearing, it's going to hold pat.
Well, that's right. Yesterday they announced that they were going to continue with the liquidity program in the same form as before. For me, it would be a lot tidier, really, to move more towards exiting the excess liquidity that they're providing, particularly on the 3-month long-term refinancing operations to the banking sector, and to leave the main policy rate where it was. They're going about things the other way. I think the way they're going about things is more complicated. It means, for example, that the overnight interest rate, called EONIA, is likely to be more volatile and more fluctuating and harder to forecast in the months ahead, really. But I think this goes to show that for the European Central Bank, there are still concerns about some parts of the banking sector in the Eurozone, hence the excess liquidity program, and at the same time they want to send a preemptive signal in order to thwart any spillover from the commodity prices into core inflation.
Julian, we thank you so much for the time, for your insight. Julian Callow joining us there from Barclays Capital in London. He is a member of the ECB Shadow Bank Council.